Hello everyone, and thank you for joining us today. In the interest of time, we might get started now, and for today's presentation, BetaShares SMA Model Portfolios. Before we start, I need to highlight a few things. Firstly, this is a webinar for financial advisors only and is not for distribution to retail investors. And secondly, all information in this presentation is general in nature and does not take into account any individual personal circumstances. A recording of this webinar and accompanying slides will be available in due course. Please feel free to ask questions using the toggle button at any time, and we'll endeavour to answer them at the end or follow up with you individually. Okay, now that the formalities are out of the way, please let me introduce ourselves. My name is Vinnie Wadhera. I'm an Executive Director at BetaShares, responsible for our institutional and advisor services nationally. And I've been with BetaShares for over 10 years now. I'm also joined by my colleague and our Chief Economist, David Bassanese. David is the chairperson of the BetaShares Investment Committee. He's been with BetaShares for 8 years. Prior to BetaShares, he was an economics contributor to the Australian Financial Review and an economist at the OECD in Paris. Hi, Dave. Thanks for joining.
Hi, Vinnie. Great to be with you all.
Great. So look, today we're going to cover 4 areas on this webinar. Firstly, I'm just going to give a quick update on BetaShares. Secondly, I'll share some points around the application of managed accounts for model portfolios. Thirdly, we'll run through the BetaShares SMA portfolios that are on the North platform, high-level process and key features. And then lastly, the very comprehensive advisor service and support that we've put in place here. Look, in terms of BetaShares, BetaShares is an Australian founded fund manager that specialises in ETFs. Our business was founded 11 years ago and we've had very strong growth. So the current stats of our business, we have 69 funds that are on the ASX, over 22 billion of assets and over 80 staff. In terms of our market share, we have, both 2020 and 2021, we had a market share of 26%. That ranks us number 2 in the ETF fund manager space and ahead of several of our global managers, competitors in this space. But we believe we've received this strong support from institutional investors and advisors really for 2 reasons. Firstly, it is our unique and differentiated investment strategies that span across low-cost passive, smart beta factor exposures, asset class exposures, thematics and ESG. And secondly, our very comprehensive service and support that spans across having a dedicated account manager, educational material, portfolio analytics and the like. But most importantly, why I'm highlighting this is because the same level of service and support that we have applied to our ETF and our ETF business that has propelled us to these levels and market share is the same level of service and support that we are now applying to our SMA model portfolio service. And I'll come to that in a moment. Let's now move on to SMAs. Now, I'm not going to run through a lot of detail here because your platform representatives, particularly the North platform, do a great job of this in terms of highlighting the benefits and all the technical features of an SMA. And they really do centre around operational efficiency. The big one, of course, is no ongoing ROAs for portfolio changes. They've probably shared a lot of information in terms of how managed accounts can strengthen your advice value proposition and how they can form a very core part of a portfolio. And of course, they offer transparency for clients, particularly individual holdings where they get the look and feel of a real portfolio. What I will, however, share is just a few interesting survey results relating to managed accounts. And the first one is from Investment Trends. They're a market research firm. And looking at their report from last year, all of the trend indicators are increasing for financial advisor adoption of managed accounts. And separate to surveys, the real results are increasing also for managed accounts. The Institute of Managed Accounts, IMAP, produced an annual survey. Their consensus survey last year had managed accounts at 111 billion. And the SMA category, so the separately managed accounts category, increased a whopping 82% in 1 year, from 23 billion to 51 billion. So that really does quantify the adoption of managed accounts in Australia. Looking at another question that Investment Trends ask advisors is, why do you utilise managed accounts? And the groupings here show really a focus in a few areas. Firstly is around administrative or practice efficiency features. It frees up time, efficient implementation, and lower compliance. And the other big one there is it allows clients to see the underlying, well, it's shares and ETFs. So that's the transparency benefits. Another interesting question relates to, what do you look for, you as an advisor look for in selecting a model manager? And right at the top of the list there is good performance. Of course, that's the ultimate results there over time for a model manager. But also strong on this question were the replies relating to manager commentary, service and support. So they're important also, particularly when you're looking at an outsourced solution here. Another question related to, what do you require to meet the best interest duty for an SMA? And right at the top there is comparing fees and charges. Second also was assessing the expertise of the model manager, and then of course an independent third-party research rating on the model portfolios. Again, BetaShares can assist in all areas of these best interest duty requirements. And lastly, in terms of the managed account space, is an interesting survey that I found from Morningstar from the US. Now they have a much more developed market for managed accounts. They have some 1,500 model managers in the US market. And in this survey, the question was asked, what are the attributes when you are appointing a model manager? And the number one attribute was actually fees. The second one was open architecture. And certainly a low-cost SMA meets that need of fees and open architecture. So again, I didn't go into a lot of details on managed account functionality. Your North representative can share a lot more information, and we can also follow up. But in the interest of time, we might now move on to the application of ETF SMA model portfolios. There are really 4 applications that we've highlighted here. The first one is an important one. This is where you as an advisor choose not to take on the role of portfolio manager. So you're outsourcing to an expert model manager. And that allows you as an advisor to focus in other aspects of advice. So that's one application of an ETF model portfolio. A second one is it can be a portfolio solution for a certain segment of your client base. It can be one where you deem at a certain dollar value of a portfolio could go into a low-cost model portfolio, or it could be a type of investor, like an accumulator, someone who's just embarking on their investment journey. And that still allows you to implement customized portfolios for larger account balances. Look, a third application would be as an alternative to industry super funds. So it's a retail super solution. It's available on a platform and it's a professionally modelled portfolio. The fees are comparable with industry super funds, and I'll show you the fees in a moment. But the big differences and advantages compared to an industry super fund are transparency, portfolio transparency. Your clients see all of the underlying holdings and they get a look and feel of a real portfolio that they can be engaged with, as opposed to some opaque structures of industry super funds. And that level of transparency we've found, and the experience of advisors, is you have more engaged clients. And the last application, which deserves a special slide, is the core satellite part of a portfolio. And this is particularly powerful on a platform where you can select a low-cost SMA portfolio, like a BetaShares portfolio, but still retain to implement client preferences for the satellite allocations. And the satellite allocations can be things like thematics, alternatives, and active managers. But that core part of the portfolio, that needs to be dependable and predictable, can be a solution for an SMA ETF model portfolio. And the reason why that's a benefit is because it is low cost, it has low turnover, and we optimize the outcomes there based on what you have selected as the risk profile objectives of the client, particularly in terms of return outcomes and risk outcomes also. So let's now move to the BetaShares SMA model portfolios themselves, and these are available on the North platform. I've articulated just some key points here. This is really a packaging of a lot of the IP in the BetaShares business. It's our capital markets IP, it's our economics IP, it's the IP of our 8-person strong portfolio management team, which have asset class expertise. It's the inclusion of some of our ETFs, which are unique and differentiated, and the service proposition around that. The people involved in the BetaShares SMA is really this investment committee, and it comprises of our chief economist, David, who you'll hear from in a moment, our chief investment manager, our portfolio managers, our product and marketing managers, and myself as an advisor advocate also. So a very well credentialed and experienced team. David, I might bring you into the discussion now just to share really 3 things, and that is firstly an overview of our strategic asset allocation, the process for our dynamic asset allocation decisions, and thirdly, exactly what is our current views of portfolio positioning for DAA.
All right, thanks very much, Vinnie, and great to be with you all today to listen in on our model portfolio process. So let me start with strategic asset allocation. And we've got the steps there. Now, this is not, reinventing the wheel. This is, anyone familiar with, the sort of Markowitz portfolio optimization process, where you look at expected returns across assets, the volatility, correlation of those assets, and you can blend up to come up with an optimal portfolio. So that same sort of, underlying theory is implicit in what we do. And importantly, it gives you it's a mathematical calculation that can justify the asset allocations across different risk profiles. So importantly, this whole process is meant to provide a reasonable basis for why certain asset allocations are consistent with certain risk profiles, which we think is very important as a bedrock for the portfolios. So just going through that, just quickly, so the steps are to look at across the different asset classes. We have 7 different asset classes: cash, Australian equities, Australian bonds, international equities, international bonds, gold, and listed property. We look at the long run expected returns for each of those asset classes, which are based on long run expected economic growth, judgments in terms of long run neutral interest rates, where you think interest rates will be in the long run equity risk premiums, long run earnings growth, and all of those go into the formulation of long run asset returns. Then we look at the volatility of asset returns on an annual basis across cash and bonds and equities, and importantly, the correlation of those returns as well. And that then goes into the optimization process to give you asset allocations for different risk profiles. And importantly there, what is the optimization? It's so take a balanced portfolio. The aim there is, given the expected returns across asset classes and the correlation of those returns, what is the asset allocation that gives you the best long run expected return subject to a risk profile, i.e. volatility of returns, consistent with a balanced risk profile. And if you look at the APRA standard risk measures, it's like no more than 3 negative return years over a 20-year period, and that's really the optimization constraint when we do the optimization process. That is all then reviewed by the investment committee. Myself and the portfolio management team go into doing that work, and then it's reviewed and discussed and agreed on an annual basis by the investment committee, and then we assign the weights to each of the asset classes. And just as an example of what that looks like, so based on the current long run returns across cash, bonds, equities, you can see, and again, we've got expected long run returns across different risk profiles. And so, for example, if I just focus on the balanced portfolio in the middle there, you can see that the expected long run return from an asset class giving you 50% exposure to growth, 50% exposure to defensive assets is around about 5.5%. So CPI plus 3, if you assume the CPI is about 2.5% in the long run. And importantly, you can see there no more than 3 negative return years expected over a 20-year period, which is consistent with the standard risk measures for a balanced portfolio. And as you go up the risk spectrum, you can get higher long-run expected returns, but somewhat more risk, and going down toward the conservative. So again, so 5 asset allocation models optimized for different risk constraints. Now, just thinking about the dynamic of so that's really that's the bedrock of the models, and so we have a strategic asset allocation again in terms of growth versus defensive assets, bonds versus equities, Australian versus international. So we do have a spread across all those different asset classes, but then we do a dynamic asset allocation process over the top. So depending on our shorter run expectations for returns across different asset classes, we will tilt the portfolios, i.e. being overweight growth assets such as equities over bonds, overweight international equities over, say, Australian equities, or vice versa. And I won't go into the details here, but basically there's 3 different processes that do go into there. We look at what are the underlying drivers of global markets at the moment in terms of trends in interest rates, trends in economic growth. We look at where valuations are for different assets classes at the moment, and how that marries with the what history would tell you one could expect from those asset classes over the next few years based on current valuations. And then we have some scenario analysis where we have like a base case view of how things will pan out over the coming year. Then we review those tilts, and again the committee meets on a quarterly basis. It can meet more regularly depending on economic circumstances, but at a minimum the committee meets quarterly to review those DAA tilts. And so just an example of some of the key thinking there. So think about growth versus defensive assets. The orange line there is the relative performance of global equities versus bonds, over the top of which is the US unemployment rate. The grey area is are US recessions. And you can see there that really during expansion phases, i.e. between US recessions, equities generally outperform, or growth assets generally outperform defensive assets. You can get pullbacks in the market, so you can get corrections in equities, but they're relatively shallow and relatively short-lived. But the big drawdowns in equities, either times of heightened risk, are where you see material risk of US recession. So we kind of focus on the risks of a US recession, and where we think that they are not material anytime soon. Then our strategy would probably be to remain neutral growth assets, or indeed overweight growth assets, and really focus on risks of recession. We don't get too cute in the timing there, trying to time corrections, for example, if we don't see a heightened risk of recession within the next 6 months to 2 years. So that's an example of how we think about growth versus defensive, just in terms of the cycle. The next one, and thinking about, again, Australia versus international. And again, our portfolios, we're very high, we really focus on a handful of key decisions when we think about dynamic asset allocation. So what you won't see in our models of lots of little micro tilts, be it to Europe, be it to small cap emerging markets, be it to any number of different little tilts you could do. We really focus on a handful of key decisions, such as overweight equities versus bonds, overweight Australian or international equities, overweight fixed rate bonds versus floating rate or cash And we think those handful of decisions can really generate most of the alpha one could hope to achieve through DAA. So just on that, for example, Australia versus international, you can see the broad trends of the relative performance of Australian versus global equities there. And this is what we're trying to capture from that DAA, being positioned for these broad trends. And really you can see over the space of 5 to 10 years, depending on what sectors are driving global markets, Australia can tend to trend in terms of outperformance or underperformance. In the late 90s, for example, technology was booming globally. We tended to underperform. Then we had a major commodity boom that lasted a decade, and Australia tended to outperform. Then we had another period of a tech boom number 2, if you like, since the GFC, and Australia's tended to underperform. And so for most of our models, since inception, we've tended to have an underweight to Australian equities because we were, the view was we're in a disinflationary, tech-driven global market where resources would underperform. Now, when we touch on current asset allocation, that has shifted, and we'll touch on that in a minute. In fact, so we'll go to that now. So as of today, this is where our DAA tilts are based on our investment committee meeting that was just held a week ago. So at the moment, we are neutral growth versus defensive assets. Now, through much of last year, we were overweight growth, and we enjoyed some good gains through the equity performance. But with the US looking to raise interest rates, signs of like late cycle, risks emerging, or signs of the US being closer to the end of the cycle than the beginning, i.e. the unemployment rate being very low, we think it prudent to go back to a neutral position and just see how things evolve. There is a non-negligible risk of a significant slowdown in the US economy over the next 6 months to 1 year, and if we think that risk, does increase, we may well go underweight, but at the moment we're not taking that position at the moment. We've also gone back to a neutral position of Australia versus international equities. Rising interest rates globally have hurt the tech and growth parts of the market, of which Australia tends to have a lower exposure to. So particularly in the last quarter, Australia's had relatively good performance from international markets. So we've gone back to a neutral position there and just sort of assessing what the key sector drivers are likely to be going forward. Will it be growth? Will it be value? And it's going to depend on how the economy globally deals with higher US interest rates. And last but not least, we have a tilt toward Australian bonds over international bonds, and that's just on a view that we think the aggressiveness of interest rate increases priced in Australia are a little bit extreme, but we think it's fair in terms of what we're seeing in global markets, particularly the Fed. So we're underweight global bonds, offset by a preference toward Australian bonds. And yeah, so give you a flavour how we think about markets and how we tilt portfolios accordingly.
Great. Thank you, David, for that overview. And of course, if anyone would like to go through the portfolio construction process in more detail and even the process inputs, please reach out to us and we're happy to follow up in that regard. I just want to now highlight the key features of the BetaShares SMA model portfolios. And these are the same features that were recognised by the North platform research team. Only one ETF model manager was selected to go onto the North platform, and we're very proud to have been selected for that mandate. So the first key feature is the low cost fees. Here is the breakup of the fees. The underlying fund fees are 21 basis points. The portfolio management fee is another 21 basis points. And then the platform administration fee, we've done this on an indicative $750,000 portfolio value, and it's based on the North Choice Super and pension pricing. So you can see that comes in at 24 basis points. So the all-in fee before your advisor service fee is 66 basis points, which is very cost competitive. Now, low cost doesn't mean that there's no or low value. The value can be delivered in different ways. And the way we deliver value, well, the first one is the low cost. The second one is dynamic asset allocation, as David has taken us through. So our belief is that, well, firstly, asset classes, just like stocks and bonds, deviate from their true value. The question is, what as a model manager will you do about that? One thing to do is to only do strategic asset allocation, so that is the do nothing approach. So you essentially tie yourself to the mast like Ulysses and avoid the siren song. But our approach is to do something, and that is, in a very judicious, modest way, is to tilt the portfolio to either generate additional alpha or to manage downside risk. And there's really those 4 key decisions that David ran through that we focus on. Our third key feature is a best of breed fund selection. So our fund selection process is based on a criteria. The criteria is about matching the objectives to the asset class. And the outcome of that is a mix of BetaShares ETFs and Vanguard ETFs presently. You may not know the ASX ETF codes, but anything starting with a V there is a Vanguard fund: VBND, VIP, VEU, and VTS for international equities. And that's important because as an SMA, your clients see the underlying fund holdings and the fund names, and they'll see for these model portfolios a mix of funds from BetaShares and Vanguard. The fourth distinguishing feature is a utilization of a mix of traditional market cap indices, what are traditionally known as passive indices, and smart beta. Firstly, on the market cap indices, these are a benefit to the portfolio because these indices over time beat a large number of active managers. You can see this is taken straight from the S&P SPIVA report. What S&P do here is they will table out all of the active managers and make an average of them, and they compare that to their known market cap indices. So what this is saying, if you go across to that 10-year column there, that for Australian equities, 80% of Aussie equity managers don't beat the S&P ASX 200 index. So that really means that 2 out of 10 managers actually beat that index over a 10-year period. For international equities, it's even worse. 90% of managers don't beat the market cap benchmark, so 1 in 10 managers. So again, there's a lot of benefits here of having traditional market cap passive indices as your core asset class exposures without adding the additional cost, let alone the performance outcomes of active managers. We also include, to complement traditional market cap indices, is smart beta indices. Now, we could do a whole webinar on smart beta itself. In fact, we have, and you can find a recording of that on our website. But essentially, this is an evolution of indexing, an improvement of traditional index methodologies that overcome some of the limitations or pitfalls of traditional market cap indices. And here's an example of one. We're using a fundamental index, which is represented by our FTSE RAFI Australia 200 index. And this simply sizes companies not on today's share price, which can contain a lot of emotion, but instead using accounting metrics, which creates a stable anchor weight within the portfolio. And this has a demonstrable track record of outperforming the market cap index by 1.8% per annum over time. Another interesting, what's called a factor-based index or a smart beta factor approach is a quality factor that we have in the portfolio too. And this screens for what is quality companies. Now, interestingly, active managers will share with you that they focus on things like financial health of a company, profitability, and business stability. Well, all of these metrics are quantifiable and can be included in a set of rules-based processes, essentially a sensible screening approach. And that's how value is added in these, so to speak, factor or quality factor index methodologies. And again, a demonstrable track record of outperforming, but also having some lower variability of returns too over time. And to round out the smart beta approaches is in fixed income, where it's very, very much pronounced. Traditional bond indices are what's known as liability weighted. So over time, whichever entity issues the most bonds will have the biggest weighting in the index. Presently, the government issuances have swamped the Aussie market, so those indices will have a very large percentage, over 80%, in government bonds. Now, that might not be what your client's objectives are, to hold 80% government bonds. It may not be the objectives of a model manager like us to have a weighting that large. And instead, we're using some smart beta approaches there. And certainly BetaShares has been a pioneer in this space. Our ETFs have two distinguishing features in terms of they disaggregate fixed income to their sub-allocations. You may not know the ticker codes here, but sub-allocations like floating rate notes, hybrids, government bonds, corporate bonds, and corporate credit, I should say also. And that allows a model manager or a portfolio constructor to target outcomes better in the portfolio. And in addition to that, are better index methodologies. So our index methodologies target specific duration profiles, they have better liquidity profiles, and they explicitly target what's called roll yield to generate some extra return. But in essence, these are the building blocks for the BetaShares SMA model portfolios. As an aside, these are building blocks that are used by a whole lot of different institutional investors and other model managers also. In terms of performance, we've got the December results here, but we'll certainly share with you all once all the managers put in their results for the March quarter. And you can see here our DAA growth portfolio, which is our 25-75 growth defensive split, compared to the Morningstar multi-sector average. And you can see the outperformance there over, well, all time periods. So that really rounds out the key technical features of the BetaShares models. I'll now just move over to the advisor service and support, because we do present this as one of the other key features. What we have put in place here is a total surround sound support for you and your clients. So we've created SOA templates, monthly fact sheets, detailed quarterly reports, client-friendly material to share with your clients. And here's a snippet of it. As a follow-up, as part of this recording, we'll also include some of that regular reporting and the client-friendly material. At the centerpiece of it also is a very client-friendly short video. You can see it's a 3-minute video here by David Bassanese, our chief economist, that covers what's happening in markets, what our asset allocation views are, and a performance review of the portfolios. So we've had some great feedback here from advisors and their clients that are receiving this and invested in our model portfolios. We have a superior rating from SQM Research for our model portfolios, and we're happy to share that with you as a follow-up too. In terms of the availability on North, here are the platform codes for our 5 portfolios from conservative to high growth. Our model portfolios are also on all the other major platforms. So if you'd like to receive the platform codes for those portfolios on those platforms, please let us know, and we're happy to send those through to you. So again, in summary, the key features of the BetaShares model portfolios are, firstly, yes, we undertake dynamic asset allocation. Secondly, we use a best-of-breed ETF approach. Thirdly, we're using a mix of market cap and smart beta methodologies. Fourthly, they're cost-effective. I shared the total fee load there with you, including the admin fees. And then fifth is that very comprehensive reporting service and support that we've put in place. We might pause there. There's a lot of questions we've received here, but I might start, Dave, with a few questions relating to portfolios to you. Firstly, the question has come in, do you hold gold in these portfolios?
Look, at the moment, we don't hold gold. We do have capacity to have gold in the portfolio. It is it is part of the suite of the asset classes that we look at, but the strategic allocation to gold is 0. So we don't have an allocation to gold, but in the right economic environment, for example, briefly during COVID, when there was equities, there was obviously a trend toward gold as in a risk-off flight to safety move. We did position into gold and actually benefited from some of that. But at the moment, we don't hold gold. We think the outlook for gold is a little bit mixed at the moment because interest rates are rising, inflation is high, but rising interest rates, particularly in the US, is checking some of the outperformance, well, the returns you might otherwise see in gold. So we don't see a case for it at the moment, but it's certainly there in the right environment.
Thank you, David. I've got a question here. Are your models screened for ESG? Look, the short answer is no. These are our conventional standard DAA model portfolios. We at BetaShares are a leader in the ESG space. Our ESG ETFs have in excess of 4 billion in assets. We have a suite of diversified ESG ETFs, and very recently we actually have launched a separate series of model portfolio SMAs that are ESG minded. They are available on 2 platforms, not North, but we are certainly sharing that information with the North team. But if you'd like more information on that, please reach out to talk to us. David, one more question for you is, where do you believe we are in the economic cycle and how are you positioned?
Yeah, good question. Look, I think it's probably fair to say we're at the, closer to the end of the cycle. And I look at the US unemployment rate. If you recall that chart I showed earlier, US unemployment now is down at 3.8%. So it's as low as it's been historically, certainly as low as we've seen prior to the last few recessions. So that means the economy doesn't have a lot of room to grow strongly any further, at above trend pace. And if anything, the economy may well start to slow. So certainly end of cycle. Now, around those sort of potential turning points in the cycle, our strategy is to go back to a neutral position. So that way we don't have to get the timing, exactly right in terms of being, overweight, underweight. So, we're at a neutral position and we're sort of watching carefully as to how things develop, but we'll probably stay at neutral. And I said, if anything, there's probably a heightened risk of a downturn in the economy and equity markets over the next year or so, in which case, as that emerges, we may well go underweight. Our strategy would be to go underweight and avoid some of the worst of the downturn during a recession. And again, that's one of the advantages of a tactical approach, because a pure strategic approach, you're just going to have to sit through it.
Thank you, David. One other question here is that, do I need to be listed product accredited? Look, generally the answer is no, but please check with your compliance team. These SMAs are a product. They're a product in their own right. That's the structure of the product on a platform. So they are not a listed security. So it's like investing in any conventional managed fund. Look, we're out of time. There are a stack of other questions. We will follow up with each advisor individually. If you'd like any further information, please reach out to us. And in any event, your BetaShares account manager will follow up with you. So you'll receive a recording here and you'll also receive a call or email request from your BetaShares account manager. Thank you all for joining us today.